You're staring at a chart, news hits, and you think you cracked the code about fundamental analysis. You jump in, the market then slaps you hard. Why? Because 95% of traders, probably you, miss the real game in fundamental analysis. Bear with me for 4 minutes, and in this video, I'll straighten your fundamental analysis for good. Okay, here's the deal. Markets don't care about what happened. They care about what's next. Every single moment, they're literally whispering about what's next. And fundamental analysis isn't about reacting to a headline like Fed cut rates as expected. Unless it was unexpected, but again, Fed cuts rates as expected. So nothing surprising, nothing to do with it. Instead, fundamental analysis is about sniffing out the story the market tells itself after the news drops. Because price moves only momentarily on the event itself. Again, unless the event is completely unexpected, but regularly after the short-term reaction, the market then moves on the expectation of what comes after. So if you're basing your market swing trading decisions purely on what happened, you're already behind. So don't react to the news itself unless something is completely out of script, like if the Federal Reserve cuts rates unexpectedly, that's a different story. But outside of that, don't react to the news itself. Instead, trade the rumor, the expectation that it creates. Because it's not about reacting to what is, it's about anticipating what the market thinks comes next. That's what sets your trend after a macro event. Take this example. The Federal Reserve cuts rates by 50 basis points, the dollar tanks, right? Logical. So you short it. Feel like a genius. Fundamental analysis is easy, right? But then Powell takes the microphone, all cool and composed as is usual, and he says, alright, we're not gonna cut rates any further. And just like that, the dollar rolls back. So what just happened here? Fundamental analysis is a hoax? I mean, shouldn't a 50 basis point be bearish for the currency? Yes, but no. The 50 basis point rate cut became quickly old news as soon as Powell mentioned they were not going to cut rates any further. Markets don't care about what happened. In this case, the 50 basis point cut. They care about what's next. In this case, the hawkish forward guidance from Powell saying no more rate cuts. So don't just skim the headlines. Don't just look at the rate change. Dig into the forward guidance. Dig into what the market thinks happen next, because most traders get stuck to the surface level, They get caught reacting to the headline instead of thinking ahead. And more so than that, also understand that markets move on expectations, and price often moves before the news, not after. You probably heard this as buy the rumor, sell the news. That's exactly what it is. And here, for instance, you can see the dollar weakening into that 50 basis point cut. Because let's say the Federal Reserve openly comes out, as they usually do, saying that they are going to cut rates at the next meeting. What do you think happens here? The market will just sit quietly waiting for the interest rate decision to then suddenly jump 150 pips as soon as the rate cut is announced? No, it digests the forward guidance, it understands the message, and it prices that in advance. By the time the Federal Reserve does cut rates, the market's like, okay, we knew that, thank you. And the move's already done. And retail traders are left wondering why the dollar didn't drop more of it. I mean, seriously? What about the 100 pips it dropped right before? That wasn't random. Markets move on expectations. If the Federal Reserve hints at an upcoming rate move, the market doesn't wait around for the actual meeting, it's time to adjust immediately. So when the interest rate adjustment finally happens, the reaction might be muted because the market already moved in advance. The event was already priced in. Maybe partially, maybe completely, but still. Now with that said, this should be your new lens. Fundamental analysis is about what's next, the expectations, the rumors, the context, the lead up to the event. So next time a big macro event happens, ask yourself, what's next after this? Or how expectations are going to move going forward. And when a big event is like 1 or 2 weeks away, ask yourself in advance, what is going to happen there? Build your expectation ahead of time, because the market does the same. Fundamental analysis is not just about the single macro event itself, it's what goes on around that with the anticipation, the build-up of expectations, and then the sentiment after. Because the event itself, unless it's something completely unexpected, it can become old news as soon as it's out. So you have to trade the expectations. That's how you properly do fundamental analysis. Don't look behind, look forward.